In the wake of the FFIEC's 2021 interagency statement on model risk management for bank systems supporting BSA AML compliance, there's ever-increasing focus from the regulators on how banks and credit unions are managing their various systems in place for detecting suspicious activity, whether that's within an anti-money laundering context, sanction screening context, or even in an anti-fraud context. There's ever-increasing expectations now that you're going to be properly managing your model's risk. But when you look at it from a practical perspective, sometimes that guidance can seem as it falls short from how things actually operate and function on a day-to-day basis. And even within the FFIEC's April 2021 interagency statement, they acknowledge that the original model risk management guidance back in 2011 missed the mark because it was designed for a wide array of different models, such as commercial lending. And even within the April 2021 statement, the FFIEC describes those as being guiding principles of model risk management in a BSA AML context, rather than detailed and comprehensive sets of expectations. While they offer a few examples here and there, they did not intend to set those expectations or standards within that particular guidance. So with that guidance gap being what it is, we hope to provide a quick bite with a brief practical overview of some key controls you can have in place so that you can make sure you're managing your model risk properly on a high level. The key control categories are change management, data quality monitoring, and performance monitoring. So again, what do those all mean? Let's first start with change management. What this really boils down to is making sure that you document. Can't stress that enough. Change management controls are crucial because you need to be able to explain any change made to your system in a way that can demonstrate to examiners that you've considered the risks of making those changes and have accepted them, or at least acknowledged the risk and determined that it's negligible or manageable. So again, what does that look like from a practical perspective? Typically, that's going to be some form of an analysis document and a summary that's provided to management within the organization, and a secondary approval process to make sure that it's not just one person or individual making the change without any oversight. But of course, the level of detail and support that you need is going to be directly in relation to how substantial that change is. When it's just a small adjustment to, say, a specific customers, whether they're going to be suppressed from alerting or perhaps have a custom set of expected activities set for them, that may be something that's done within a BSA department without any additional oversight. Whereas something such as changing an entire set of agents or rules or whatever the system refers to it as that is a monitoring function, those may need to go up to a higher level, such as a risk management committee or an audit committee. So again, it all depends on the risk. The level of detail needs to line up with that. Data quality monitoring is another major key category of controls to have in place. And within this category, there are a couple of different sets of controls that are extremely important to have. One of them, of course, is frequent import monitoring. Monitoring the import of data is something that should be happening on a regular basis, day to day even. When you're looking at the transactions that get into the system from their source systems and into the AML system, there should be a process to make sure that you can identify when there have been failures on that import and whether they may be missing transactions or perhaps a sanction screening list had not been updated. And it's pretty typical for many a vendor to have these in place, whether it's through an email process or a reporting process. What we often see not happening is that the institution themselves haven't put in policies, procedures, or even records to demonstrate that they're looking at these communications from the vendor and responding to them in kind. Another one, of course, is self-testing, and typically that's most effectively done after any kind of change that you have within your system, but also then on a more periodic basis as opposed to your daily monitoring functions. And that is going to entail sampling different transaction types, making sure that not only does it show up in the system, but that it shows up how you need it to, particularly in those key risk fields. Perfect example here is going to be wire transfers. Most AML systems are designed to look at not only the dates, dollar amounts, but also the countries involved, the names of the counterparties for each transaction. With that, it's crucial to periodically sample and make sure that that information, that enhanced data, is getting brought into the system so that your rules and scenarios can function as they need to. The third key category of controls is performance monitoring. And while that's a pretty wide array, I mean, what we're really talking about here is suspicious activity monitoring functions and also risk rating functions in the system. And there's a few different ways that's typically handled within any given organization. One of them, of course, is to look at the ratio of valuable work versus work that's less valuable. And what do we mean by that in the AML context? Is, of course, looking at the number of alerts compared to the number of SARs filed for any given scenario, and using that data to then identify those scenarios that may have parameters that are set too low and are producing too many false positives. In addition, another subcategory of controls here is model challenge. And in fact, you could arguably say it's more of an organizational mindset than a subcategory of controls in and of itself. But what that really means is that you're working with your system, and as a financial institution, you're always thinking about the impact of the program and whether the program is done what it should do. And that can arise in a multitude of different ways, such as identifying false negatives and doing testing of benchmark models. And what do we mean by those? Well, first off, looking back at false negatives, that's a situation where, as a bank or a credit union, you're filing a SAR on activity. However, there was no alert produced. Organizations should focus on those events and do a post-mortem analysis to determine what exactly happened with the system and why it wasn't an alert. And the conclusions from that may be a number of different things, but making sure that you have that as an organizational mindset is key to working with your vendors so that they can improve their models, or within the system itself, identifying changes that you can and will make. Benchmark testing is when you take essentially a parallel model, something that has the same purpose. Perhaps it's a much simpler version that you can build from reports of data that you have from the core or other various systems, and look at it side by side with the results from the system. And when you do that, what you really want to focus on, of course, is the gaps, where you have something identified from Model A versus Model B, and focusing really on your system and determining why it is that there were not alerts produced in certain areas and what the risk is after identifying that root cause. Lastly, a very common form of performance monitoring is to conduct below-the-line testing, and that's when you take the results from the production functions that are there, such as your various scenarios, but you look at the activity that would have generated an alert had it been set differently. So essentially, if you're applying a risk score to a potential alert at a certain number, you're going to look below that line. And if you have certain parameters, for instance, over the amount of activity that is required to trigger an alert, that could be another instance where you're looking just beneath that line. And when you do that, you're sampling and evaluating that activity, and the question in mind is always going to be, does this warrant an alert? And would it be valuable if we were to, as a team, be reviewing this type of activity? So while these are all important steps that any institution can and should be taking as part of their own self-testing and model risk management, it's also key when to know that you need to use an independent firm. So of course, to learn more about this, we encourage you to reach out to us so that we can discuss when it's appropriate and what we can do for you in those circumstances.